Very good evening, everyone. We will start in another 3 or 4 minutes, so thank you for waiting. Very good evening, everyone. We will start in another 3 or 4 minutes, so thank you for waiting. Very good evening, everyone. We will start in another 3 or 4 minutes, so thank you for waiting. A very good evening to everyone, and thank you for taking out the time. I really do hope that you are all healthy and are safe and are doing well. Like we did last time, just a couple of minutes of background on what we are trying to do through this platform. This platform is a world of financial reporting platform where the idea is to exchange knowledge. What we will do today is this time we will take a more deeper dive into the Ind AS 116 amendments. These amendments are a direct consequence of COVID-19. So, and therefore they are extremely practically relevant in the current scenario. The other piece of knowledge sharing item that we would like to pick up is we would like to just give a very quick overview of what the LIBOR reforms are all about. It's a significant event that the entire financial markets will see. This has impacts more than just financial reporting. So two themes that we wanted to cover during our day today. We will hopefully make it more interactive and hopefully you have a good session today. So to begin with, let's just talk about the Ind AS 116 accounting. Right. Ind AS 116, to introduce it very quickly, is a standard that has completely changed the way lease accounting happens. This accounting standard has brought about a sea change for lessees in an operating lease. Gone are the days when you could fly in an aircraft which was not in anybody's books. For those who are not familiar with this, the chairman of IASB once remarked that once in my lifetime I want to fly from New York to London in an aircraft which is at least on somebody's books of accounts. That is exactly what the old accounting standard on leases in the IFRS framework did. It was possible for the lessor to de-recognize the asset by calling it as a finance lease, and it was perfectly possible for a lessee to consider it to be an operating lease and only have the lease rentals on the books. This was a classic situation where the entire lease accounting was abused, which eventually resulted into a source of off-balance sheet financing for many. This standard aims to correct that, and it does correct it in a large way. This standard proposes a single accounting model for all lessees. So gone are the days when we used to separate the operating leases and the finance leases. This standard has a single accounting model, the right of use model on the books of all lessees. So a single accounting model for lessees, what that means is that its balance sheet becomes grossed up. You now have a right of use asset and you have an obligation for the lease rentals that are to be paid out. So gross up on the balance sheet, this has naturally significant consequences on the covenants and on the overall financial position and performance of the company. Let me spend a minute on tell you how it will eventually work out in the financial statements. Earlier, all of the operating lease rentals were recognized as a cost by the lessee in the financial statements. In the current scenario, what will happen is because there is a right of use asset, the asset gets amortized. And since the future lease rentals are recognized as a liability by discounting them at the incremental borrowing rate, the unwinding of the borrowing results into an interest expense in the P&L. So what was earlier a part of the operating costs now gets segregated into interest expense and amortization of an intangible asset. Very crucially, what this does is, while this does negatively impact debt equity ratio, debt by service coverage ratios, it has a very significant positive impact on EBITDA. Now, as management, it is very critical to keep in mind that some of these measures like EBITDA were earlier non-GAAP measures when one looked at public issuances. Very important, therefore, to keep in mind that in the future, if there is a significant public issuance happening and a non-GAAP measure like an EBITDA is used to explain the performance to investors, this is an item which should be clarified, because the EBITDA in the erstwhile accounting standards would have included this as an operating cost, whereas an EBITDA under the Ind AS 116 framework means that the EBITDA is that much higher. However, not all is so straightforward in the standard. Every operating lease, if it had to come on the books of the lessee, it would just simply mean that much more operational effort on part of the lessees. Even the smallest of all the leases would meet the definition of the right of use or the requirement to have a right of use on the books. That, friends, would make it operationally cumbersome for preparers of financial statements. In order to avoid this situation, there is a practical expedient that is available in the standard. What this practical expedient suggests is that if the lease term is a short-term lease, that is, the lease term is 12 months or less, then there is a choice available for a class of assets to scope them out as a lease from the point of view of Ind AS 116. Are taken on a lease for a short term, the costs continue to be recognized in the P&L as part of the operating costs as they used to happen earlier. The other exemption that's available is for a low value asset. Often entities that are large end up leasing assets such as IT equipments, computers, laptops. These assets are several in numbers, and to calculate the present value of each of the payouts track each asset separately would have become extremely cumbersome. In order to provide relief to preparers of financial statements, what the standard does is it allows entities on an asset by asset basis to scope out low value assets from the point of view of the calculation of the lease rentals or from recognizing an ROU asset. Very interesting to note that on a material basis, the amounts that get scoped out could be significant, but the standard, however, considers an asset by asset threshold for application. So you could have one asset which costs, say, for example, 1 lakh rupees. You could say it's a low value asset and scope it out. But imagine if the client has 10,000 units of such asset, 10,000 multiplied by 1 lakh could in aggregate be a very material amount. But the standard does not look at it that way. It just says, make the decision on an asset to asset basis. One single asset, not material, small value item, please go ahead and account for it as a normal lease as you would have in the earlier gap. With that background about what the standard is, what are the key changes the standard has brought about, let's break the session or the discussion into 2 or 3 parts. In the first part, we will do a quick recap of what is a lease, what are the requirements of the accounting standard with respect to leases. In the second part, we will talk about or do a refresh of the guidance on the modification of a lease. We'll talk about what is a modification of a lease, what are the accounting consequences of this modification guidance, both for lessors as well as a lessee. And once we've got up to speed with what the standard requires, we will then talk about why the need of the expedient and what the practical expedient actually aims to achieve. With that, let's just straight away head into our topic. Right, the standard defines a lease to be a contract or a part of a contract that conveys a right to use an asset for a period of time in exchange of consideration. If one had to just break this definition down, the first and the most important element that one would need to keep in mind is that there needs to be an identified asset in the first place. Let's take an example here on the slide, and I'll draw your attention to this company, which has 3 cranes and 1 plant. Now, when I say the asset needs to be identified, what I'm suggesting is that the standard states that in the contract, you could write, we will take 100 units of output produced by your company. This agreement does not state that the output should be produced by plant X, right? The asset is therefore either implicit or implied in the contract, or it could be stated explicitly. Now, for a contract to be a lease and not be a service contract, this is a gating question. And the assessment should go like this, that the lessor should not have a substantive substitution right available. What this means in simpler terms is A, the lessor should not be able to practically substitute the asset. In our example, if the lease talked about the plant, the lessor only has 1 plant. The lessor is not in a position to substitute this plant, and therefore the plant becomes an identified asset. On the other hand, if the contract was to supply 1 crane, the lessor has a practical ability to substitute the cranes because he has 2 more other cranes which he could lease out or replace, as the case may be. So the first condition is there a practical ability to substitute the asset? The answer is yes, there is a practical ability to substitute. The additional step one would need to assess in this case is, would the substitution be economically beneficial to the lessor, or would it be economically not beneficial or detrimental to the lessor? If it is economically detrimental to the lessor, in that case, the lessor does not have a practical right to substitute the asset. So the right to substitute the asset may be on paper, but it is not a substantive right. Friends, in this case, one would stop at this stage and say that this contract is not a lease, it is not a leasing contract, it is out of the scope of Ind AS 116. one would then look at other guidance in different accounting standards to conclude as to whether or how one should account for the costs that are paid in respect of that standard. Now, having concluded and passed through the gating question and said, yes, the asset is an identified asset, the next element that the standard requires us to focus on is, does the customer control the right of use of the asset throughout the leasing period? And this is often where contracts that may provide an ability to get an output from an asset, but do not end up becoming a lease. So let's take the same example further and break down what does control the use of the asset mean. As per the accounting standard, control the use of the asset would require two conditions to be satisfied. The first one is that substantially all of the economic benefits of the asset would need to go to the lessee. When one talks of substantially all of the economic benefits, these economic benefits are generally in the form of sale consideration or use of the products. It could be use of byproducts, but the point is, or it could even be, for example, if one has the right to sublease the asset. All of these would contribute in the assessment of whether substantially all of those economic benefits are available. To take an example to distinguish as to which would be a service contract versus which would be a leasing contract, let's take the same example of the lease of the plant. In my example, let us suppose party A contracts with party B to take an asset on lease. Now, if the number of units that are purchased from party B constitute only 30 or 40% of the output of the plant, then one would conclude that substantially all of the economic benefits of the plant, the asset under question, are not received. And therefore, one would conclude that this is more of an outsourced manufacturing contract or a contract for services and not a lease. Alternatively, if, for example, 90-95% or more of the output was considered to be a part of the contract, to be a part of the arrangement, then one would conclude that yes, indeed, substantially all of the economic benefits of the plant will accrue to the lessee. And that therefore would have then required the lessee to have assessed the last condition, which is how and for what purpose test. Simply put, the standard then takes us to the next level to say, yes, the asset was identified in the first place. You are getting a substantially all of the economic benefits of the asset. But more importantly, do you control the use of the asset? And this is where one needs to assess the purpose of the arrangement and how the arrangement is actually administered. Just a few basic questions that one would need to look at. The first one being, who decides the output? Who decides how much of the output is to be produced? Who decides when will the output be produced? Who would decide what the product mix would be from that particular asset? In a majority of these situations, the contract would state some of these explicitly. If the contract states that it is the lessor that decides or takes these key decisions, then one would say, yes, the lessor does control the use of the asset. If, however, the contract states that it is the lessee that decides or makes these decisions, then this would fail the definition of a lease. It would go back to a servicing contract. In many situations in practice, it is not always easy to identify. Those are situations where this could be predefined in the contract. In which case, there are two things that one should look at. First, who designed the asset? If before the contract was entered into, it was the lessee that actually gave the directions as to how the asset should have been set up, then that is a clear example that the asset is effectively under the control of the lessee. Alternatively, there could also be a situation where the lessee has directed the manner in which the asset is to be operated. Now here one would need to also conclude that the lessor does not have the right to override those instructions. So for example, the lessee gives an SOP on how the asset is to be operated. But if the lessor can override that SOP, one would then say that, look, this is not a lease, but a service contract. With that background about what is a lease, let's now jump straight away into what is modification of leases. And once we spend a few minutes on what's the modification accounting for leases, we could then go back and look at what does the new standard have in store. Okay, let me throw up a polling question here. The situations are there in front of you on the screen. There are 5 possible situations. Why don't we spend maybe a minute and see what's the house view? What I'm looking for is, there are 5 situations on the slide. Which out of these would be considered to be a modification of lease under Ind AS 116? Okay, I am getting a few votes. And let me read it out for the benefit of those who are using a mobile phone to access this webinar. The first option is 10,000 square feet of space was leased at inception. Subsequently, another 2,000 square feet was also leased. The other situation is 3 floors of office space was leased at inception, and subsequently 1 floor out of the 3 was given up. The third situation is 10,000 square feet of space was leased at inception for 3 years. At the end of the first year, the lease was extended for 2 more years. The fourth situation is 3 floors of an office space was leased at a rent of 15 lakhs a month. The rental was subsequently renegotiated to 12 lakh rupees a month. The last situation is an asset was leased for 3 years with an option to extend it by another 3 years. At the beginning, based on considering the facts of the way the business was operated, the lessee said the lease term is 3 years. At the end of the first year, the lessee thought, well, I have a choice to extend it by another 3 years. Let me extend this to 3 more years. Yeah, responses are trickling in. 80% of us on the webinar have polled. Let me end the polling. Oh, we are getting more responses. Okay. Let me wait for another 10 seconds and then close the poll. Okay, let's end the polling. All right. Let me quickly share the results. 75% of the participants said, or those who voted, said that the first example is that of a lease. 14% said it's not. 63% said the third example is a modification. 63% said the fourth is a modification. 69% said the fifth is a modification. Okay, let me end the suspense. What does the lease modification accounting require? And then we can think about what answer we give. In simple terms, what does modification mean? Modification means that something was there in the agreement, was agreed between the parties on day one. At a later point in time, the parties decided to change the arrangement. That, friends, is an example of what the standards talk about, modification of leases. I know there is also a concept called remeasurement of a lease, which is a new concept and was not there in the old Ind AS 17 or IAS 17. But what that means is, if there is a change in the agreement which was never a part of the agreement to begin with, that is an example of modification. But if there was something in the agreement and circumstances changed, because of which one had to modify the accounting or modify the arrangement, that is a remeasurement under the accounting standard and not a modification. And the accounting impacts of both of those could be different. So now with that in mind, let's look at this example once again. In the first case, we said 10,000 square feet at the beginning, another 2,000 square feet were leased. Now, if this additional lease of 2,000 square feet was not a part of the contract, this is an example of a lease modification. In the second case, we said 3 floors of office space was leased at inception, 1 floor was given up. If the option to give the floor up was not a part of the original contract, then this, friends, is an example of a modification. The third example says 10,000 square feet of space was leased at inception for 3 years. At the end of the first year, the lease was extended by 2 more years. Now, presumably that there was no extension clause when the agreement began, in which case, this, friends, is also an example of a modification of a lease. The next one is 3 floors were leased at a rental of 15 lakhs. It was negotiated down to 12 lakhs per month. Now, if this negotiation was never a part of the contract at the beginning, then this change or change in the consideration is also an example of modification. The last one is where the contract itself had a provision for a lease of 6 years, with 3 years as the primary period or the non-cancelable period, and the next period of 3 months was an option to extend the lease. At inception or at commencement of the lease, the lessee thought, I am not going to go beyond 3 years. But come end of 1 year, the lessee said, this looks to be an attractive proposition. I will extend the lease by another 3 years. In this case, the option to extend the lease was already a part of the contract on day 1. And therefore, example 5 on this slide is not a lease modification, and the accounting for modification of leases does not trigger. To just summarize quickly, what are the kinds of situations where modification would apply? The first one could be where the scope of assets in the lease increases. The second example could be where the scope of assets in the lease reduces. The third situation could be the rentals change, the term of the lease changes, that is to say the consideration changes, the terms of the lease change. These are broadly the situations where modification accounting is triggered. Modification accounting is not a practically easy accounting answer, although there is guidance on how to account for it, because it involves a lot of judgment to be exercised, and it involves a fresh set of computations that lessor and lessees would need to make. And that is exactly the reason why in the current situation, if the lessee goes up to the landlord and says, look, my sales are impacted, please reduce my rental. That reduction in rental would trigger a modification accounting for the lessee and the lessor. And that is exactly the kind of hardship that the standard setters did not want preparers to undergo. And that's the reason why this modification, the accounting expedient to not apply the modification accounting was rolled out in July 2020. So to summarize what a modification is, lease modifications, as we said, are extremely common. A lease modification could be a change in the scope of a lease. It could be change in or reduction in the consideration, or it could be change in terms and conditions. They are commonplace. Anyone who has a struggling business, who is struggling in the current scenario, would easily walk up to a lessor and tell the lessor, please change the leases. Please reduce my rental. Please give me a deferral. Please waive my rent. Please waive my rent for 3 months and extend the term by 3 months. All of these are possible. The good thing is the current standard gives guidance on how to account for them. The other thing that one could expect is that any change that results from a renegotiation would also be a modification, which is also an example that we saw. We also spoke that Modifications are different from reassessments. The example 5 on our slide was a reassessment. It was an assessment that was made pursuant to a change in the facts and circumstances. The guidance for accounting for remeasurements is that the discount rate does not change. You change the new cash flows that you expect, but discount them back using the original incremental borrowing rate that the lessee had considered, or the rate implicit in the lease that the lessor had considered. Whereas in a modification accounting, you would effectively end up taking the new cash flows and discounting them with the incremental borrowing rate or the rate implicit in the lease as of the date of the modification. So therefore, we will therefore far more appreciate the expedient that has come in. It does not require us to change the discount rates. Importantly, Ind AS 116 is silent on how do you account for a remeasurement or a reassessment of lease liability for lessors. In practice, you go back to what guidance prevails for the lessees, but there is no explicit guidance available for lessors. As we said, to summarize this, a key distinction in the modification accounting is that something should not have been a part of the original lease contract. Let's now quickly summarize what the guidance on modification of leases is all about. Right now, on the slide, what you see is, as we said, it has to be a change in a contractual term and condition, something that did not exist earlier. What could those situations be? Those situations could be, as we said, it could be an increase in the scope, or it could be a decrease in the scope of the lease, or it could be other modifications. So once again, going back to our polling question, I had 3 floors, I increased 1 floor. That is an example where I'm adding more assets. I had 10,000 square feet, I add 2,000 square feet more. That's an example where I am increasing the scope of the lease. I had 10,000 square feet, I said business is not doing well, I'm not getting enough footfalls, I will cut down a part of my office, give it back to the landlord, or decrease in a scope of lease. I had a lease of 20 retail outlets, I don't need 20 of them, I need 15. Decrease in the scope of a lease. Any other modification, say for example, the rentals are not affordable, please give me a discount, please make the new rentals as 80% of the old rentals. This is an example of any other lease modification. What does the guidance tell us? It says logically, if there is an increase in the scope of the lease, please assess that the new asset that gets added to the scope of the lease is at a standalone selling price for that asset. To give you an example, if I had 10 floors with a rent of 1 lakh per floor, if I'm adding 1 more floor at a rent of 50,000, then that is not at the standalone price for which I could get 1 floor. But if I add that 1 floor at a rental of 1 lakh or even 1,05,000 or 95,000, that could very well meet an example of the increase being at the standalone price. That being the situation, the flow in the standard is quite clear. It says if the asset scope increases and the increase is at its respective fair value or a respective standalone price, you account for it as a separate lease. In which case, what you will do is for the new floor that is added, if you are paying a rental of 1 lakh rupees per year for a 5-year term, discount back that 1 lakh rupees that you are paying over a 5-year term to today's value using today's rate implicit in the lease or today's incremental borrowing rate if you are a lessee. And we are now only to begin with focusing on the accounting for the lessee. So please remember there are only 2 accounting captions that could likely be impacted on the balance sheet: the right of use asset and the lease liability. This is not a finance lease, operating lease discussion anymore. For the lessee, single model of accounting, right of use model of accounting. So the standard suggests if you are going to increase the scope of the asset, and the selling price is the fair value of the asset at which you would have otherwise got it, please consider it as a fresh lease as it is. Do not change the accounting of the existing leases that are available. On the other hand, if you had 10 floors of office premises on rent, each floor had a rental of 1 lakh rupees, and you had recognized a present value of all of those rentals as a right of use asset and a corresponding lease liability. Subsequently, if you were to give up 2 floors, what the standard requires us to do is to do a pro rata reduction of the right of use asset and the lease liability and recognize any difference as a profit and loss on derecognition. So if the ROU had a carrying amount of 2 lakh rupees and 50% of the asset was given up, the new ROU that we would see in the balance sheet would be 1 lakh. We would reverse ROU to the extent of 1 lakh. If the corresponding lease liability was 1,20,000, the new lease liability would now only be 60,000, which means I debit my the lease liability by 60,000. So the liability reduces by 60,000, the asset reduces by a lakh of rupees. That results into a loss on derecognition of ROU of 40,000, which goes through the profit and loss account. For the balance 50% of the assets that continue to be in the lease, do not change any accounting. And that's why the standard says don't treat it as a separate lease. Whatever was a prorated new cash flows, continue to account for them using the discount rate that you had on day one. So don't change the discount rate, make a pro rata reduction, and then recognize a gain or loss on the derecognition. We will look at a few examples to just reiterate this concept, but principally speaking, new asset added, treat it as a separate ROU with today's discount rate. If an asset is derecognized, recognize a profit or loss on derecognition. For anything else, remeasure the lease liability and adjust the ROU. But more importantly, you do that by taking today's discount rate. So take the discount rate of the date of modification, remeasure your asset and your liability, and recognize the difference by adjusting the ROU. Right, let's take a look at a couple of examples to reiterate this concept. At this stage, once again, I would like to remind you, we are talking about the accounting for lessees. We will come to what the lessor also needs to do. Okay. Let's read this example for a minute. And there is one important point that would be relevant from a practical perspective, which I will highlight as we go about the discussion. Here is an example of a lessee entering into a lease to lease one floor in an office building for 10 years. The business has expanded. At the beginning of 7 years, the lessor and lessee amend the contract and said, why don't you use one more floor for the balance period of time? Now, what is important is that the lessee says, look, you don't have to go about hunting for a lessor. You don't have to do a background check for what the lessee is going to be. You will save costs on doing an assessment of whether the lessee is genuine, will pay rents on time. Please give me a 5% discount. Now, what the standard would require us to assess is effectively what is the impact of this 5% of discount on considering the condition that the standalone selling price or the standalone lease rental of the new floor is also at an independent or an arm's length price. So would this be accounted as a separate lease? The assessment is yes, this would be accounted as a separate lease for two reasons. The first one is, this is clearly an increase in scope. And we said there are two conditions. The first is that there should be a scope increase. Having concluded that there is a scope increase, the next assessment that I would need to do is whether the additional rental that is to be paid is commensurate with market rentals for a similar space. In this case, although the rentals are lower by 5%, the conclusion would not change for the reasons that this is effectively an impact or a benefit that the lessor gets by not having to incur other costs. If one had to lease this property out to a third party or an unknown party, the lessor may even have had to pay a brokerage or a fee. This 5% discount is a reflection of that piece of the transaction, which the lessor would have otherwise had to incur. And one would therefore conclude in this case that the lease rentals are commensurate with what a similar property would have fetched. And that therefore means that the additional floor gets recognized as a separate lease. So you will separately find out what are the future cash flows of this lease obligation, present value them using the incremental borrowing rate at the beginning of year 7, and then work out the ROU and amortize the lease liability. Let's now look at another example of a modification. And this is where we will cover the other two scenarios. Remember, at this stage, we are still talking about the lessees. For the lessors on the group, we will come back to what the lessor accounting also is. Lessee Z enters into a lease contract with lessor L to lease certain amount of space in an office building for 10 years at a at a lease rental of 1 lakh per annum. The incremental borrowing rate on that date is 7%. If one had to discount 1 lakh rupees for 10 years at the date of inception, the present value of that on day 1 would have been 7,02,000 rupees. There are a few questions in the chat box. We'll try and answer them in parallel, or otherwise we will surely come back to you at the end of the discussion. So coming back to our example, let's just focus on this example. On day 1, present value the 1 lakh rupees payable for 10 years, discount them at 7%, which is the incremental borrowing rate. So on day 1, the lessor has, or the lessee has, a right of use asset of 7,02,000 rupees, and at the same time recognizes a lease liability of 7,02,000 rupees. At the beginning of year 7, the lessee sees that the business volumes have reduced and wants to give up 25% of the space. Additionally, the lessee also says, please reduce my rentals by 25% and let it be reflective of the current market scenario. The lessor and lessee agree. At the beginning of the 7th year, the discount rate on the lease has now moved to 8%. The accounting treatment that the lessee would have followed is they would have, on the 7,02,000 rupees of ROU, amortized that for 6 years and taken that amortization as a charge through P&L. So one would see a lower balance of the ROU at the beginning of the year, which works out to 2,80,000 in this case. And on the lease liability, they would have recognized interest expense at 7% on 7 lakh in year 1, adjusted the 1 lakh payment, and accordingly would have arrived at a lease liability outstanding of 3,38,000. Friends, this example covers two scenarios. It covers the scenario of derecognition or a reduction in the scope, and it also covers a scenario of a reduction in the consideration after a part of the asset is given up. The standard states don't treat them as a separate lease because the scope is reducing. However, there is a distinction to be made in the sense that on the portion of the assets that is given up, which is the 25% floor space, a gain or loss on the derecognition of the ROU and lease liability would be recognized in the P&L. Thereafter, one would give impact to the reduction in the consideration. Let's look at what exactly would have happened in terms of the numbers. As we said, it's a two-step process. Step 1, determine the carrying values of the ROU asset and liability before the modification. Now, after the modification is done, effectively the lessor and the lessee said that only 75% of the asset will be within the scope of the agreement. So if one had to take 75% of the ROU should be reflected in the books at 2,10,000. Similarly, the liability would also correspondingly become 75% of the liability before the modification. So 75% of 3,38,000 is 2,54,000. The accounting entry in this case would have been to debit the liability by 2,54,000, debit the liability by 84,000, credit the asset by 70,000. This would have resulted into a gain on modification, which is recognized in the P&L. So as part of this entire plan that we have seen so far, two things have happened. The first thing that happened is we have accounted for the scope decrease. We have said a part of the asset is given up. If an asset is given up, you recognize a gain or loss on the modification. And that, in our example, is a gain of 14,000. Now the position that I have reached is I have now reflected an ROU asset and a lease liability by discounting 1 lakh rupees for 75% of the space at 7%, which was the rate on day 1. However, the standard or the counterparties have agreed, let's reduce the rent to 75,000 instead of 1 lakh per unit. This is an example where my consideration has reduced. And we said that in case a consideration reduces, you will need to present value the future lease rentals or the new lease rentals that are agreed using today's discount rate. As a lessee, therefore, I would have calculated the present value of 75,000, which is a reduced rental, and discounted it by 8%, the incremental borrowing rate on the date of the modification. As we can see, that would have given us a present value of 2,48,000. The financial statements, however, reflected a carrying value of 2,54,000. So the way to bridge this gap of 5,600 is by crediting the lease liability by 5,600 and debiting the right of use asset by 5,600 rupees. A change in the consideration is P&L neutral because it impacts the ROU only on the date of the modification. Of course, it will come through the P&L in the future by way of amortization of the ROU, but on the date of the modification, it is P&L neutral compared to an example where the scope itself is reduced. Because if the scope is reduced, one would need to take a gain or a loss on the modification to P&L. This, friends, summarizes the accounting for modifications for a lessee. These are situations one would exactly expect to see in the current COVID environment. The economic impacts are felt by everyone. Lessees may want to negotiate either by giving up space or by reducing the rentals or by seeking deferrals, seeking waivers. All of these are examples of modification accounting. And in most cases, if the modification was in terms of the consideration and not the scope of the asset, one would have to therefore estimate what the new revised cash flows are, discount them at today's incremental borrowing rate, and adjust the ROU. So cumbersome exercise, practical in a practical sense, and that is where there is an entire expedient that has been brought about. Before we move on to what the practical expedients actually are, Let us recap the accounting that a lessor would apply. Now, recall that the accounting for a lessor has not changed. A lessor still classifies a lease as a finance lease or as an operating lease. Therefore, this makes the accounting for modifications by a lessor slightly more complex. Let's take a few minutes to discuss the accounting by a lessor. The lessor has to first assess whether the lease that is subject to the modification is a finance lease in the books of the lessor or is an operating lease in the books of the lessor. If the lease is an operating lease, then after the modification, the lease is considered to be a new lease. What it means is that let us suppose a lessor used to charge 10,000 rupees of rent every year and had an escalation of 5% every 2 years. In this case, the lessor would have calculated the amounts post escalation and would have worked out a straight line amount to be recognized as lease rental income. This would have also created a lease equalization reserve in the books of the lessor. What the accounting guidance states is, in such a situation, if the original lease was an operating lease and there is a modification to that operating lease, what you would need to do is take out all the new cash inflows under the revised terms and adjust the lease equalization amount. So if you had a lease equalization reserve of 5,000 that was outstanding in the books on the date of the modification, and the summation of future lease rentals was 50,000, on a straight line basis, you would recognize 50,000 less 5,000. So you would only straight line 45,000 over the remaining lease term. And that's how the accounting by an operating lease happens for a lessor where there is a modification. Straightforward to understand, again, practically cumbersome, but at the end of the day, the standard has not given any relief to a lessor. So any lessors, if you are going to be someone who is giving a benefit to your customer by way of a reduced consideration, you will need to track what is the lease equalization reserves in your book and adjust that to arrive at the future lease income that you will earn in the books. Nothing else changes from an operating lease standpoint from a lessor's perspective. Let's turn our attention to the modification accounting by a lessor, where the subject matter of the lease is a finance lease. Once again, we'll go through the same flow. After the modification, is the scope of the asset increasing? If the scope of the asset is increasing and the increase is at a rental which is then prevailing in the market, then you account for it as a separate lease. Once again, a fairly straightforward scenario. On the date of the modification, if you are going to add one more floor in the leasing arrangement and you conclude the lease rental and charging is the market rental, you will now discount all the minimum lease payments at the rate implicit in the lease. And because this is also a finance lease, you will de-recognize your asset in the books from property, plant and equipment or investment property and recognize a finance lease receivable, which is a financial asset in the financial statements. Because it's as a lessor, if significant risks and rewards are transferred, we would have always been used to de-recognizing the asset and recognizing a receivable. That continues even in the current situation. Again, what would change is the discount rate for the MLP would be the discount rate prevailing on the date of the modification. In other cases where the scope of the asset is reducing or the consideration is reducing, the standard requires us to go back to the day of inception of the original lease and assess as to whether on that date had I applied the new terms, would my classification have been an operating lease or a finance lease? So let us suppose that I started off with a finance lease on day one. 2 years later, I changed the terms, I changed the lease rental. The standard takes me back to the date of commencement of the lease or inception of the lease and tells me if you would have applied the new rental throughout the lease term, would your assessment have been that it continues to be a finance lease or would it have been an operating lease? If you conclude that no, with the revised terms, if I had known them on day one, and this is important, where at inception, if it would have been an operating lease, then you now have a new operating lease. So what you would do is you would de-recognize the finance lease receivable and recognize a property, plant and equipment or an investment property back in the books of accounts. Because you are saying it's no longer a finance lease, I now have an operating lease. So if you have an operating lease, the asset comes back on the books, the financial asset gets de-recognized. Alternatively, if you concluded that no, even after the change, my finance lease continues to remain to be a finance lease, that is when you apply the guidance under Ind AS 109 that deals with a modification of lease. And to spend a quick 1 minute on what the modification guidance under Ind AS talks about for a financial asset is it says, please assess if the modification is a substantial modification or not. A substantial modification arises out of qualitative changes to the agreement or quantitative changes to the agreement, which are greater than 10% of the carrying value before the modification. If either of these two conditions are met, you de-recognize the old lease receivable that you had in the books and recognize a fresh financial asset for the lease receivable. Any difference in that flows through the P&L. On the other hand, if the modification is not substantive, then you recognize this transaction by adjusting the EIR. So once again, friends, interplay between multiple accounting standards for a lessor. Important to keep in mind that each of these situations could practically impact, again, whether you end up with a property, plant and equipment back on your books, if you have a financial instrument, de-recognition of a financial instrument. If, of course, your new lease is a finance lease, then you have one more finance lease to deal with. So little more complications if you talk about it from the standpoint of a lessor, for the simple reason that a lessor has a dual model of a finance lease or an operating lease. And let's once again look at a couple of examples to cement the concept in our heads. On this slide is an example where there is a lessor Z who enters into an 8-year lease of 40 lorries with lessee M. The lease term approximates the economic life. There are no other features that indicate that the lease does not transfer substantially all other risks and rewards incidental to ownership of the lorries. On day one, therefore, this is classified as a finance lease. At the end of year 2, lessee M decides to cease one of its business operations, because of which it needs to terminate the lease agreement early. They now terminate or they now change the terms of the agreement such that the contract now terminates at the end of year 4. Early termination was not a part of the contract. This is therefore a lease modification. The modification does not grant M an additional right to use, and therefore it is not a separate lease. As we said, now the way we would need to account for this is we would need to say on day 1, if I always had a lease of these lorries for a 4-year term, what would have been the lease classification? In this case, I would have concluded that the life of the lorries is maybe much more than 4 years. Hypothetically, if I had to assume 8 years, I would have said the life of the asset is not a majority of the economic life of the asset. Also, given that the life is now 4 years on day one, the present value of lease rentals for 4 years would not have been substantially all of the fair value of the asset on day one. I would have therefore concluded that this lease had been or would have become an operating lease on day one. That being the case, we said there are two steps one would need to follow. The first step is to derecognize a finance lease receivable. Because this is no longer a finance lease, it's now meeting the definition of an operating lease. Bring back the lorries as property, plant, and equipment, and the amount at which you would measure them, which is step 2, is the aggregate carrying amount of the assets immediately before the lease modification. And that is how you would have accounted for this particular modification. Let's look at one more example before we jump into the practical expedients. And this is an example where an operating lease is modified into another operating lease. Lessor Y enters into a 10-year lease of office space with lessee X. Y classifies this lease as an operating lease because it does not transfer substantially all of the risks and rewards. The lease agreement specifies a starting rent of 1 lakh payable in arrears with an escalation of 2% per annum. And if one had to do the math, one would have paid 1.094 million over the 10-year period. The accounting for this is on a straight line basis, and the rental therefore that would have been recognized is about 1,09,497. Given the high vacancy rates in the real estate, both the parties have now come back to renegotiate the contract. And what they are saying is that let us extend this lease by another 5 years and let us revise the rental to be 1,10,000 per year for the remaining term of 5 years plus the extended term. Now what one would need to do is there is a payout of 1,10,000 per annum for 10 years, which would result into 1.1 million of lease rentals. But friends, remember there is a lease equalization reserve in the books of this company because their payout was different from the amount that was recognized in the P&L. That needs to be adjusted against this aggregate of the rent that will be paid over the 10-year period, and then one would arrive at the straight line basis of lease rental income to be recognized. This is a very quick summary of what is the new leasing standard or what is Ind AS 116 about, and what is the real guidance on modification for lessees and modification for lessors. What the practical expedient does is it says, given the current pandemic, many entities will expect to renegotiate rentals, renegotiate their terms of arrangement with the lessors, which would meet the definition of modification. In order to simplify financial reporting and life of participants, there are certain practical expedients that have been brought about in the standard. The first and the most important point to be kept in mind as we look through and work our way through the expedients is they do not apply to a lessor. So if there is a lessor who is giving a rent concession, the lessor has no choice but to apply the examples that we just saw. But for the lessee, there is a choice available if they want to take the benefit of the practical expedients. What does a practical expedient talk about? The first and the gating question is the rent concession a direct consequence of the COVID pandemic? If that answer is a no, then you do not get any benefits. But if you believe that no, this is a direct consequence of COVID-19, then there is a choice that the entity has. An entity could say, I will ignore the practical expedient available to me, treat it as a lease modification, and go through the entire process of re-estimating whether it's a separate lease or not, adjust the ROU, and so on. Alternatively, it will say, let me take the benefit of the modification. Take the benefit of the modification and apply the practical expedient. So it's a choice that is available, and this, given that it's a choice, also triggers disclosure requirements for preparers of financial statements. But three key requirements to apply this particular choice. Because it's a choice, it comes with riders. There is nothing like a free lunch. Three things to be kept in mind. First one, is the revised consideration substantially the same as that immediately prior to the change? Second key criterion that comes along is that the reduction in payments should only impact payments that are due in the contract on or before 30 June 2021. And the last one, there is no substantive change to other terms and conditions of the lease. Let's now take and spend maybe a few minutes to look at this in a little more detail. Why don't I quickly open up the poll? Okay, we've seen the example, and let's now look at what the assessment is. Retail chain X leases several of its stores and the headquarter building. COVID-19 cases were identified in the country in March 2020. The company observed fewer falls and fewer sales. Subsequently, a nationwide lockdown was announced, and the company decided that it would have had to close some of its outlets for customers. In January 2020, a rent concession was agreed for the head office building because of the refurbishment that had to happen in the building undertaken by the landlord. The lessee said this is causing inconvenience, and therefore the lessor said, why don't we enter into a reduction in the rentals? Now, the question that we are trying to assess here is, would X be able to apply the practical expedient to head office building, retail outlets, neither of them, both of them, or there is an accounting policy choice? At this stage, friends, we are talking about the gating question. Yeah, we are getting responses. Let's just wait for another few seconds and close this. Okay, interesting responses. So no one believes that the head office building alone is entitled to a concession. However, 13% of the participants believe that there is a choice available to apply to both of them. And interestingly, 13% believe that there is an accounting policy choice to apply to either of them. So interesting results. I think what we are now trying to talk about is the gating question here in this example. Is it a direct consequence of COVID? And this is where the element of judgment comes about. In my judgment, or based on the facts that we see here, the rent concession for the head office building is not related to COVID. It is because of a refurbishment activity undertaken by the landlord. So there is no accounting choice available for the office building. The office building is a clear-cut accounting for modification of lease rentals for both the lessor and the lessee. But with respect to the retail outlets, there is judgment that can be applied. And the judgment that can be applied is to say, is this really directly related to COVID? The answer is yes, it is related to COVID. And it is because of the fewer footfalls, because of the lockdown, and the fact that my sales are not happened, that in my judgment, this is direct consequence of COVID. And this is the gating question. If at this stage one says, no, it's not COVID, the rest of the discussion on practical experience is not relevant. But if it is related to COVID, then the rest of the discussion assumes importance. What one would need to do is, frankly speaking, fairly common sense type assessments. Look at when did the renegotiation of the rentals get discussed. Was it way in advance of COVID? Was it after COVID? What does the documentation indicate the reason for the renegotiation? What was the timing of the renegotiation? In many cases, the renegotiation may have happened before the lockdown, for example, but that may have happened because the suppliers for this company were from places where COVID has had a much significant impact before March. And therefore, although the lockdown and COVID was observed in this country in March, it had a direct impact because the supply chain had started getting impacted from December, January onwards. So you could still conclude that, yes, this is a direct consequence of COVID. Alternatively, one could say that, no, this had nothing to do with COVID at all. My impact only started from March. Also, in a lot of cases, lockdown alone is not relevant in the assessment. So one could still say that if the rental gets negotiated after the lifting of the national lockdown, it could still be an impact, or the concession could still have an impact of COVID. And the reason for that is, although the lockdown is lifted, people are still hesitant to come out of their homes. People are practicing social distancing. The number of footfalls that I would have otherwise seen in my retail chain will now drop significantly. All of these could be attributed to be a direct impact of COVID. And that, friends, therefore, would meet the gating condition. Now let's look at the other three criteria that we spoke of in some detail. What are the three criteria? The first one we said is the revised consideration is substantially the same or less than the original consideration. Now this applies only where the lease consideration is substantially same. If the lease consideration is significantly different, then it would not apply. One of the ways in which one could assess this is to say, what is the impact in present value terms? If in present value terms, the new rentals are more or less equivalent or substantially the rentals before the modification, one could conclude that, yes, this condition is indeed met. Right. So you could also have a situation where, for example, the lease rental is increased, but that increase is only to compensate for change in time value of money. So either the consideration remains the same or it increases, but if it increases only to compensate for time value of money. A third situation is, as a lessee, I am not doing enough business. I don't have the cash flows to pay the rent at all. Now I unilaterally decide not to pay a rent. That, friends, does not allow me the benefit of the practical expedient because it is not agreed in the contract. So any rent reduction should have been agreed in the contract or should have been specifically agreed in the contract. I don't have the ability to pay rents and therefore I don't pay the rent, does not in any way permit me to apply the expedient, unless both the parties have a contract which says, I understand you have a liquidity problem, I am reducing your lease rental. If that does not happen, friends, then this practical expedient cannot be availed. The other condition that we said or spoke of was that the payments had to be due on or before June 2021. This should be 2021. My apologies for this. The practical expedient really puts in a time bar because it does not want it to be evergreen. The standard setters, no one knows the real impact of when, or the real timing of when the pandemic will stop impacting us. But there has to be an end date. So what the standard setters in their wisdom thought, let's put an end date. let us say that only those payments originally due before 30 June 2021 will be considered in this. Otherwise, one could start structuring contracts to try and take benefit of this guidance, which is what was not required to be applied. So they wanted to prevent any implication of a broader application of this expedient, direct impact of COVID, and only up to 2021. Finally, it could have an impact on comparability. There is no denying that some companies may choose, some could avail the expedient, some may not. Some could choose rent, may even decide at a later point in time that I want to negotiate my rentals which are impacted by COVID-19. But be that as it may, the idea is to give relief to those who are impacted and to give relief to those who want to avail the relief. And that's why, while there could be some lack of comparability, it is only going to remain for a limited period of time. Another quick example to talk about why the 30th June 2021 is relevant. Lessee X leases an office building from A. As a result of the pandemic, in September 2020, the lessee agreed to reduce the rentals by 50% per month for the next 12 months. Now here, if the assessment is, would the lessee be able to apply the benefit of the lease rental? The answer is no, because we only look at lease rentals originally due up to 30 June 2021. And in this case, there are lease rentals that will be due originally under the contract after 30 June 2021. So for example, the July-August 2021 rentals would be after the cutoff date that is prescribed in the standard. One could also then go ahead and ask as to, can I break this 12 months down into 9 months plus 3 months? But the answer to that is that the standard does not permit that kind of a breakdown. You look at the new term that you have negotiated in its entirety, you do not break it down into 9 plus 3 and then do the assessment. So in this case, the lessee X will not be able to avail the expedient. The last one is condition that we spoke about was one which does involve some amount of judgment as to whether there are any substantive changes. The term substantive changes are not defined in the standard, but a lot of this has to be drawn based on the judgment in the terms and conditions of the standard. So for example, if there are absolutely no other changes to the contract except the term, except the amounts, except the quantum of assets in scope, one could logically conclude that there are no other substantive changes. More importantly, this may not really have too much of a practical implication, because let's keep in mind that there are also two other conditions one would need to satisfy, which is the PV of the new cash flows compared to the PV before the modification on account of COVID. Second, and more importantly, there is a specific time period within which the amounts have to be due originally as per the contract. So given those three overall broad brush parameters that are there, this one is more of a prevention of abuse rather than having a meaningful practical impact. So no practical difficulty expected from this one. Now, having looked at how does one avail the expedient, let's turn our attention to what the practical expedient actually is. We've crossed the gating question, we've crossed the accounting policy choice, and now we are saying, as a lessee, I am willing to avail the amendment. I am willing to apply the amendment. Logically, there could be broadly two types of benefits that one could get from this kind of a negotiation. One is a complete holiday or a complete waiver of rent. Another one is a rent deferral, saying, I understand you don't have the cash now, please pay me the cash later, but please pay me to either compensate me for time value of money or just pay me the notional amount of cash flows. So rent deferral with or without escalation or time value of money, or waiver of rent. Waiver of rent could either be conditional or it could be unconditional. And let's look at the approaches that are available for a lessee to account for this. Let's first start with the example of a rent deferral, which probably looks to be the more practically prevalent scenario, where the lessor says, instead of not paying me at all, why don't you pay me some money at a later point in time? Let's take one example and talk about what are the approaches that are available. So the first thing that we should keep in mind is, when a rent concession involves a deferred payment only, the change is accounted for by recognizing the impact in the period when no payment is to be made, by continuing to reduce the lease liability. So effectively what we are trying to say is that the lease liability should reduce for the period in which it was due, because you have to reflect the fact that you have got a benefit from the waiver, or you've got a benefit of a deferral. So your lease liability should get impacted because of this change. Let's take an example and see what are the two approaches that are possible. Lessee X enters into a lease contract with Y for an office building. The lease commencement date is 1st of March 2020. The monthly payments are 2,000 rupees per month, payable at the end of the month. The incremental borrowing rate is 6%. The business has seen an impact on account of COVID-19 and a rent concession is negotiated. The effect of this negotiation is that the rent for the month of July is deferred, and instead future lease rentals are revised to 2,100 rupees. So what I have done is I am saying, effective from the month of July 2020, there are 20 more months left in this lease agreement. Please pay me 100 rupees more in each of those months, and don't pay me any rent for the month of June. So there is no rent to be paid in June. So the payout in June is 0, but that amount is effectively adjusted in the next 20 lease payments by paying an additional 100 rupees. Let's assume all the other conditions of the practical expedient are met. No substantial difference in the agreements. Then the other condition around the rent concession being the period before June 2021 being met, all of those conditions are met. Option 1 that is available to account for this is to recognize this deferral based on the original terms of the contract. So what I would do is remeasure my liability by discounting 2,100 rupees that I will receive in each of the subsequent months with my original incremental borrowing rate of 6%. And this is where we said there is an expedient available. Instead of taking a new rent or a new discount rate, keep the original discount rate. What it would have then meant is, effectively on 1st of March, my ROU asset and liability would have been a present value of 10,000 rupees per month, discounted at 6% per annum. Just before the modification, my ROU asset would have been 39,485 and a lease liability of 39,776. Under the revised terms, my ROU asset would not have been impacted. What would have got impacted is my lease liability, and this 39,874 is the present value of 2,100 discounted at 6%. As you can see, this results in a difference in a lease liability of 98 rupees, which is recognized in the P&L. So this approach does impact P&L. It does not impact ROU, it impacts the lease liability and impacts P&L. But let's look at what would have happened if the expedient was not availed. Had the practical expedient not been availed, one would have said, is the scope of the asset decreasing? The answer is no. We would then have said, okay, it's not a new lease because scope of asset is not increasing, scope of asset is not reducing. What I have done is change the rental. We would have discounted 2,100 rupees by the prevailing discount rate on the date of modification. we would not have discounted it by 6%, but would have discounted it by the rate prevailing on 31st of May. And that would have then got adjusted to the ROU asset and not to the P&L. So that's approach one that is available in the expedient, in applying the expedient. Approach two would be to ignore the time value of money of that 100 rupees. What this second approach says is effectively you bifurcate the 2,100 rupees that you are paying in the future into payouts of 2,000 rupees of the original liability and 2,000 rupees of the rental for the month of June. In this case, you do not remeasure the lease liability, do not remeasure the ROU asset. And I'll very quickly talk about how the leasing schedule would have looked in that case. On the date when the lease would have started, both the liability and ROU would have been at 45,126. We would have recognized an interest expense at 6%, recognized a payment to reduce the liability, and would have come at a closing balance of 43,351. We would have done the same thing till we reached the end of May. Now, effective June, I have a payment holiday, so I don't pay anything. But time value of money on this outstanding balance continues to accrue. I recognize 6% of interest expense. As you can see, my liability at the end of June has gone up because I have recognized an interest expense. Thereafter, I adjust the 2,100 rupees, out of which 2,000 goes to adjust the original lease, and 100 rupees for the next 20 months adjusts the deferral of the rent for the month of June. Eventually, this balance will run down to zero because I'm segregating the 2,100 into 2,100. The 100 offsets this 2,000 rupees, barring the time value of money, the standard permits it, and the 2,000 rupees offsets the original lease liability. This is how one would possibly account for deferrals of lease payments as a lessee. Let's now look at another example of waiver of lease payments as a lessor. As a lessor, as we said, two possible situations. Either the waiver is unconditional or the waiver is subject to a condition. If the waiver is unconditional, recognize the benefit as a variable lease payment in the period in which the concession is granted. So for example, if the lessor tells us, please don't pay me the rent for the month of June, you directly credit P&L in the month of June by debiting your lease liability. You debit the lease liability because it's no longer an expenditure. But if the concession is available subject to conditions being met, one will only recognize them as the condition is met. So for example, if the condition was that the lockdown should continue at the end of the month to get the waiver of the rental. Now, in the month of April, the lockdown had continued. That is the time one would have debited the liability due for the month of April to the lease liability account and credited P&L. If the lockdown continued in May, one would have then done the same treatment for the month of May. If the lockdown was released or not put in place at the end of June, one would then have said this amount is now due, the waiver is not available. And that's how one would account for as a waiver of lease payments. You treat this as a variable lease payment and the impact goes directly to the P&L account. So you recognize this as a benefit to the P&L account and reduce the lease liability on the balance sheet. That is how the entire accounting for the practical expedient of the leases work. We looked at what's a lease, we looked at the modification guidance for lessors and lessees, and then finally we looked at what is the practical expedient available for a lessee. There is no practical expedient available for a lessor. Having then looked at this, let's turn our attention to the next item that we are picking up. This one has more of a business impact than an accounting impact, and I'm conscious of time, so I will very quickly talk about the key business impacts of this proposed change. Friends, as many of us would be aware that the UK FCA has stated that at the end of 2021, banks will no longer be forced to publish the LIBOR rate. LIBOR, to recall, is a London interbank offer rate. The way the LIBOR rate that is derived at is worked out is that at noon UK time, select large financial institutions like banks give out a term structure of interest rates. So they tell, if I have to lend money to another bank for a period of 1 month, the interest rate that I would charge is X. So they give this for a wide range of tenors. They give it for 1 month, 3 months, 6 months, a year. All the 17 or 18 odd banks that are there that are constituents of this group publish their rates. The UK FCA then says, let's take out the top and the bottom extremes and give the central value. So the LIBOR rate that we are so used to seeing is a polled rate, is a rate that comes about a poll. A lot of us are familiar with how that polling process was misused by certain banks, which therefore prompted the regulators to think about having a different kind of a rate. And they said, let's not have a LIBOR in place anymore. No more interbank offer rates. Let us now have a risk-free rate, which, for example, in some jurisdictions could be a rate like a SOFR, where effectively it says, if one had to lend money on an overnight basis, on a secured basis, in a risk-free manner, what would have been the rate? So a big change is a LIBOR was a forward-looking term structure rate, which gave you interest rates for different terms. The rate that we will now see is a risk-free rate for placing money overnight. Big difference, therefore, commercially, because today, if I have to borrow a 3-year ECB loan at LIBOR plus 300 basis points, that LIBOR incorporates an element of interbank risk. Come 2021, my pricing of loans will be based on a risk-free rate, let's call it RFR. That RFR is only an overnight rate. So to get from LIBOR plus 300 to SOFR plus a spread, I would need to walk from a risk-free rate, from a rate which factors in interbank risk, to a risk-free rate, and then add a spread to say that this is an overnight rate to move to a forward-looking rate or create a term structure. So commercially, it is a big change. One will, to just give you context, there are about $350 trillion of contracts that are dependent on LIBOR alone, which will undergo a change. Now, commercially, one will have to work out what that spread is. Both the counterparties will have to agree to that change. So that's the business part of the change. From an accounting standpoint, as you would have guessed, very quickly, 2 key accounting impacts. One is the impact on hedge accounting, and the other one is the impact on modification of loans accounting. Why would hedge accounting be impacted? Simple answer to that is that hedge accounting would get impacted because the hedged item was a LIBOR plus 300 basis point loan. If the hedged item does not exist anymore, a hedging relationship cannot exist anymore. So that's the first impact. Second impact is if one commercially renegotiates a LIBOR plus 300 basis point loan into a risk-free rate plus 400 basis point loans, how does one apply the guidance on modification of cash flows? Because the cash flows will now get modified. Ind AS 109 has guidance on modification accounting. So IFRS 9 has modified, IASB has modified IFRS 9 in 2 phases to, one, help companies transition to the new benchmark rates framework, and more importantly, on a go-forward basis, it will also provide certain practical expedients. So the modification of loans, which is a big operational hassle, does not work as long as there is economic equivalence of the rates. So as we said, an IBOR is a term structure of forward-looking rate, which includes credit risk of the bank. what we will move to is a risk-free overnight rate with a fixed spread. So the guidance in the standard is as long as commercially in present value terms, these two are met, one should be able to say that the loans are not modified in an accounting standpoint. For us in India, what does it mean? And how would we get impacted? Some of the commonly seen rates that we see in India are rates around the risk-free rates from FIBIL. We have the Mumbai Interbank Offer Rate. We have the MCLR, and we have MIFOR. Now, MIFOR is a Mumbai Interbank Forward Offer Rate, which uses the LIBOR plus the USD INR forward premium. So this MIFOR rate is one which will directly get impacted. And where does LIBOR feature from a transaction standpoint is a LIBOR or an interbank offer rate features in foreign currency borrowing and lending arrangements. It features in ECBs that we have taken, deposits that we've placed, impacts hedge accounting, and impacts valuation of derivatives. So very massive impact for financial institutions for sure, but equally for a corporate which is a borrower and has entered into hedging relationships. In a nutshell, there are four things or four kinds of challenges that this kind of transition will impact. The first is the business impact, which deals with the negotiation of the terms, which deals with what should be the spread in the arrangement. The second one is for professionals like us, which is the finance and the risk part. How do we ensure our hedging policies are updated? How do we ensure that, one, we have a repository of everything that is impacted in the first place? The third one is around the governance part, which is the IT and the controls, the IFC environment, identification of impacted transactions. Once you're impacted, how do you ensure that they are appropriately implemented? If you need to make a change to an IT system, which a financial institution may need to make, are they geared up to make those changes? Finally, don't forget the legal and the compliance implications. There could be changes in counterparty contracts, arrangements. There could be changes to master agreements like ISDA. So it's something, once again, which goes beyond accounting. It impacts all the facets of the organization. A big change, and therefore we thought we wanted to spend these 10 odd minutes on the LIBOR transition, not so much from an accounting standpoint, but more from a commercial and a business standpoint. So a change which will come about maybe in a year's time, but it will have a massive impact on financial markets and the instruments used in those markets. The accounting change, of course, could be significant, but that is most significant for banks and financial institutions. So thank you very much for your time. I'll keep the floor open for questions if there are any. There are a couple of questions. Yes, June 21 is what we were talking of. The other question is, if a discount is given till June 2021, then can it be taken as a practical expedient? Yes, it should have been originally due up till June 2021. I think that is the key point. You may actually make the payments even after June 2021. That does not matter. What is important is the benefit should pertain to cash flows which were due up to 2021. That is all that we had to cover. We will be back in November. We will talk about Caro, another important change. If there is any other topic you would like us to cover, please feel absolutely free. We are here to be the knowledge sharing platform. We would love to hear from you. We would love to hear your feedback. These are our coordinates if you would like to reach out to us. Thank you very much for your participation. Please stay safe. Hope you found this session useful. If there are any questions which we have not yet been able to answer, please do feel free to write back to us. There was one question, a couple of questions which I can see and I'll try and answer. One question is from Minesh. It says, how can we say rent after 7 years is effectively the same and is commensurate? No, I think the example meant that in year 7, if you're going to revise the rate, that should be commensurate. Venkat Ramanan Swaminathan has a question. It says, what is the rationale in doing it from inception? It remained operating or finance? No, okay. I think and maybe let me go back. I think what we're trying to suggest, sir, in this situation of a lesser accounting is, it says hypothetically if this change was made effective on day 1, and the reason for going to day 1 is, let's remember that for a lessor there are 2 possibilities on day 1, either a finance lease or an operating lease, and that's the rationale of going back on the date of inception of the contract and then assessing whether it would have been a new lease or not. So that's the only reason of doing it from inception, because the finance lease model or the lessor has 2 lease models to deal with. Okay, thank you everyone then. Thank you for your time. Please stay safe. Look forward to interacting with you again.